Suddenly. A very warm welcome to everybody. This is the last tutorial for um, funding initiatives in Chinese equity markets. So thank you all for coming. I know it's been a busy weeks, so I appreciate your being here. It's a very important week, so I treat you all like a very important persons or VIPs, so that's why I booked this room. Now tonight, I want to actually do a few things, and this file is already online in Blackboard. I didn't really produce a file for last week or the week before because you guys were doing the presentations. Could you hear me at the back? It's okay? Yeah. But tonight, I want to talk to you about a few things, especially on assignment number 3. I don't think I can go through the whole thing, but selectively, I'll point out the bits and pieces that I think are worth commenting on. And if there's anything you don't understand, please feel free to let me know. I want to talk a bit about takeover and privatization, and also reverse takeover, which is a really interesting topic. And then any other questions? And I want to answer a few questions that were brought up recently and some not so recently. Okay, so we'll take it from there. Now, so first thing, so in terms of housekeeping, there's not much else to add. So you've done all that. The exam is coming up this Saturday. And so tonight we are here. And this session is being recorded, not only, I guess, for your benefit, but also people who can't make it. So I'm not going to, I won't take attendance tonight because the other people from the T2 session might be disadvantaged. Okay, there won't be a T2 because that's on a Saturday morning. Better just let them do some revision at home. So the exam will be this coming Saturday. So please assemble just upstairs earlier if possible, but get there by 2 p.m. I think. Okay. And I think Paul wants to split you guys up in 2 rooms. Unfortunately, I can't be there. Okay, and I told him like 6 weeks ago. I knew I had an appointment, so my apologies. I won't be there in the exam. Doesn't happen very often, but I have to go to a wedding, so and they normally happen on Saturday. You know, it's not me. It's not my wedding. Okay, it's somebody else getting married. So sorry for that. So tonight is the night we will meet for the last time for this course. Let me just start by just taking a quick look at assignment number 3. Now, I don't want to spend too much time talking about this because you got so much information from Paul, number 1, and you have done the assignment, number 2, and you have the solutions, number 3, but I think some of these are worth discussing. And I see that, many of these actually are kind of fact-finding questions or true or false answers. And so you got a 50-50 chance of making it. I want to actually start from the second section first, okay? And now some of these are really just straight calculations. And if there's something you don't understand at any point, feel free to let me know, okay? But if they are simple, I'm just gonna quickly go through them. So here, so 36 is a question on ADS, and there is a railway, Guangshen Railway has a sponsored exchange traded ADR program, and one ADS is equal to 50 underlying shares, okay? And without even looking further, okay, I can safely assume that they have to be talking about H shares, okay, because there's no such thing as an ADR program connected to A shares as yet, okay. And the question is, so if the shares are trading at renminbi 314 and Hong Kong dollars 296 respectively in the A and the H, and they are asking for the basically the premium ratio between the A and the H. Now the H is just this one. You know that sometimes, in fact, quite often, the A and the H market, they don't trade identical. You are aware of that, right? And it's not always possible to so-called arbitrage. Sometimes the gap just stays where it is, so there is no point you trying to arbitrage. But anyway, so the A shares are trading at 314 renminbi. Now, of course, you have to find the exchange rate somewhere, which is down here. So just multiply that, turn it into Hong Kong dollars. It's trading basically at a 20% premium, and the price for one ADS would be. Hey, don't do this. Hey, what happened? Would be. Sorry about that. My PC is a bit funny today. Okay. I didn't pause it. Yeah, so you simply multiply the Hong Kong dollar share price by the number of shares per ADS. There is a discount of 1%, and then you divide by the FX, which you have to look for, 784. Okay, just down here. So that's pretty straightforward. And here it is saying for another company called ENT, where one ADS share is equal to 25 shares of ENT, and if the current value of now here, this is not nothing. This is not related to a H share or A share. This is just a simple ADR program where the shares are trading at $5, but the value of one ADR is actually $124.25, and it's asking whether there is an arbitrage here or not. What is the arbitrage profit available from offsetting 500,000 shares, which is equivalent to 20,000 ADS? Okay, so all you got to do is you can see that this one is equal to $2.5 million. This one is actually slightly less. Okay, so you want to buy this one and maybe sell this one. Okay, So you will mop up, you will sweep up the AD. So this is the ADS, and these are actually, you're going to be short selling the shares and then buying the ADS. So when you sweep it up in the market, then the number of ADS available for trading will reduce, and I think that's what Paul means by a reduction in number. Okay, but it has no effect on the actual outstanding number of shares in the company. Okay. Now, if you go a bit further down, there's actually a question where it's the other way around, where now the ADS is expensive. Okay, that's question 38, where there's an ADS of a company selling at 84.75, and if that was the case, and the shares are trading at 420, so there's a price discrepancy. Okay, but here you buy the shares and you sell the ADS. You sell the ADS, okay? So when that happens, so there will be more ADS available for trading in the market. That's why this is an increase, okay? But the shares themselves, there's no impact, okay? 39, these are just factual questions on different types of ADR programs, okay? And 41, as you know, you can't use A shares as yet for ADR programs. So, but H shares and B shares you can. Okay, so that is why you can do that, and do this. I think these are. Someone has a question? Yeah. A level 1 ADR doesn't need to have, doesn't need to be exchange listed. This one, right? It says for any level 1 program, the underlying ordinary or common stock must have exchange listed status in the market outside the US. There is the requirement, yes or no. Okay. If you refer back to here, okay, level 1 ADR, okay, exchange listed, there is no such requirement. Are you with me? Not necessarily. No, I don't think so. No. Bless you. Okay. Let me, I might actually come back a little later on regarding the conditional general offer. But I want to just quickly touch on this question 44, okay? So there is, okay, I'll give you a minute to read it. Now, the story here is there is a company and it looks like it is selling stocks to an entity called Mr. N or Miss N, and suddenly this entity or this person, the ownership goes from 0 to 40. And as you know, when you go from 0 to 30, you already will trigger. So between 30 and 50, if you are here, it's going to trigger off what's called a conditional general offer. And you guys are okay with that, right? Now, why is it called? First of all the words have meanings, okay? First of all, it's an offer, and it's a general offer, and it's a conditional one. And the condition is that, or the offer is, you basically, if you have already mopped up, okay? If you have already, how to say, you know what a mop is, right? Detour, okay? You mop it up. If you have mopped up so much shares, then you now face an obligation to offer to buy shares from anybody who wants to sell to you. Okay, that's a general offer at a certain price, which is actually the highest price you have been buying shares on in the last 6 months. But it is conditional, and it will only happen if, in the end, many people sell shares to you so much that your ownership finally it exceeds 50%. Okay, then you have to buy from all those people. You are already at 40. Okay, so if 10% or more people sell to you, you have to buy from them. Okay, but and there is like a set period, 7 days, 14 days, you have to buy from them. But if, let's say, only 8% more people buy from you, then the transaction, that 8% buy sell will not happen. That is why it is conditional. There are two possible outcomes. Everyone is okay with that? Yeah, make sure you are. Okay, and you typically will purchase at the highest price where you have been trading the stocks in the last 6 months. Okay, and so suppose that at the end of the offer period, acceptance are indicated for 0.4 million. So not many people actually sold to you. Okay, so the offer is still conditional. Okay, in fact, it probably won't happen. It's not mandatory or unconditional. And then at the end, you just stay at 40%. I'll actually talk a bit more about this in a moment. And I know there are a lot of rules and regulations and different situations, but my interest in these things, okay, there are a lot of rules, and of course you have to know the rules, okay, but my recommendation is don't get lost in the rules. And behind the rules, actually, there's very interesting, commercial psychology going on, and I want to share with you on those in just a moment. Okay, why are they doing these things? Okay, that's what really fascinates me. How much would N need to pay the shareholders indicating acceptance of the offer? Well, it's just the offer. Now they want to offer at a higher price. This is a different question. So you offer at a higher price, It's so simple, right? So 330 million sold at $9.10. Okay. Don't do this. Something funny with my PC today. Okay. Where are we? Page 8. Okay, so here, this is what? 45C. So within a pool of 600 million shares receiving the offer, assume all shares are held by parties who have nothing to do with the old controller or the guy trying to take it over. But there is a substantial shareholder within this pool, and this shareholder holds 120 million shares and SUB, and he is not related to the original or the new incoming party within the 600 million share pool. And so if this person was to reject the offer, okay, then you have to figure out what is, so the shares that are held by this guy are not in the public float. Okay, so it's locked up in his or her private account. So the number of shares in the public float will be reduced by, well, this was never there to start with, okay, but 600, which is up for potential acquisition, 120 turned it down, 330 were interested. So all these will be taken up. So what is left would be just 150 million shares, which is 15%. Now, what happens at this point? You have part of your shareholders have surrendered their shares to an incoming, somebody with big cash, such that the public float is now reduced to 15%. What happens in a case like that? 15%. In Hong Kong, there is a requirement, not just Hong Kong, many places, that the equity, which is publicly tradable, has to be minimum 25%. Yeah? You all know that. So this is actually now below that level, which means that whoever has a lot of these shares and whoever started this thing, all right, they better actually try to cough back some of it into the market, and that's exactly what they did, okay? It needs to sell at least 100 million shares to make it 250 million in circulation in the public float again. Is everyone okay? Yeah, that's good. Now, here, so consider all the, so it's a continuation from the previous question. However, this time, so N makes a general offer at an even higher price of 930. And furthermore, imagine that N makes it clear in the offer documents that it's planning to privatize this company, delist, okay, if it is able shortly after completion to secure a compulsory acquisition of remaining shares. Now, you have to, so the remaining, what are sometimes called disinterested. Disinterested means they're not buyers or they have no interest in this takeover action. Okay, so the remaining part, which is not the 400 that's being pushed around, the other 600 of that, okay, you have to get a 90% acceptance from these people. Okay, so it is it's a fairly substantial amount. Okay, so that's where the 540 comes from. Okay, now 40B is very simple. Just the number of shares multiplied by the share price. I guess it's simple once you see the answer. Okay, I don't know how you guys did when you were doing the assignment. 47 is an interesting one. Here, somebody is trying to take a company private via what's called a scheme of arrangement, or SA. Okay, this is when you actually before you start cleaning up and buying a lot of shares, you make a proposal to the shareholders, and you ask them to vote on this. Okay, and there are actually two rules, and so at the moment, just prior to the proposal, the controller already owns a substantial amount. So they basically control the company. Whenever there's a vote, they would win because they got 65%. Okay, but you want to take the company private. That's a bit more complicated. Okay. You all know here what the word private actually means, right? Private, not in the sense that it is non-government, okay? Private in the sense that it is not a, well, I guess it's not a PLC, public limited company. It is not something that will trade in the stock market. The owners have absolutely not only majority, they basically own the entire company, and they are not under any obligation to make disclosures to the stock exchange or the shareholders and so on, according to standard procedures. So the two requirements are that out of the remaining 35% of the people, if you ask them to vote, you have to get a response from at least 75% of the remaining people. Now, so 280 million actually voted. Okay, that is above 75%. So this is sometimes called quorum. I'm sure you've heard of this term. Do you know what quorum means? Quorum is when you are holding a meeting of some kind, okay? And it doesn't have to be a company. It can be a private club, and you want to pass some resolution. You need to have at least a certain number of people. So let's say you have 10 board members and 7 of them have to be there. So 70% quorum. So if you don't have even that many people, you don't have quorum, and then you can't make the decision. Okay. So the first condition is that you have to have 75%. The second condition is that you cannot have, so out of the number of people who voted, okay, you cannot have more than 10% of the disinterested part of equity voting against you. Okay, and here 40% of the people voted against, which is actually higher than. Now, this is 10% not of the people who voted. Okay, well, that would make it even worse, because if it was 40 over 280, definitely a lot of people opposed it. Okay, so if less people come, to vote, then there is a chance that the number of people who oppose it would be less than 10%, which is 35 million votes. Okay, but then if this number here drops below a certain level, you don't reach quorum anyway. Okay, so they thought of everything. Okay, so you have to have enough people who bother to vote, and the number of people who oppose this thing has to be less than 10%. Okay. Say again. What do you mean?
The number of the arrangement divided by the number of shares take part in the vote. That would be 240 divided by 280.
You mean like this? Is it? Well, that is still quorum, but no, it's not, and I'll tell you why it's not. Okay. I see what you mean. Hold on a second. So now, if it was, all right, so the number of votes that are cast have to be, or the number of people who actually bother to vote divided by the number of people who voted yes has to be bigger than this. But if the opposing vote itself, which is the difference between these two, is bigger than 10% of all the disinterested shares, okay, yeah, that reminds me of something, because then the interesting thing here is it is actually for the controller or the party coming in, it is in their interest that fewer people vote for this, because you imagine if only 50 million people bother to come and vote, let's just say, which is a very low number, okay, and so 75% of 50, so let's say 40 of them actually agree on it, okay, and because this is such a small base, even though you have 10 million people opposed, so this gap here would never make the 10% of all the disinterested shares. You know what I'm saying? So when you have fewer people turning up to these things, it may end up working to the advantage of the person who want to take over, because those who are opposing, as long as the people who turn up are going to vote for it, okay, then so you just need 37.5, okay, here, and even if it was 12.5, well, if 50 million votes came and 40 million or 35 million opposed, okay, then yes, this scheme of arrangement is doomed to fail, okay. But other than that, sometimes a small number of people can actually be an advantage. You understand my point? Yeah? You know what I'm trying to say? Yeah. This is pretty much the same, this one. Now this is about reverse takeover, and which I will talk about in a minute. And the what happens when there are assets injected into a balance sheet. Let me show you what is actually going on here, and see if I can do this. Okay, select notebook, right computer. Okay, I have actually split the screens. This one is my PC. That one is the computer. So what I want to do is so notebook, right? PC left. That's what I want. Okay, so I want to just draw the chart for you. So this is week 11. I'm going to update these tutorial notes and then put them online. I already have for some other courses. Okay. Now, okay, so you can see both. Yeah. That's why we have a room like this. So there's a private company, private unlisted company, PTY, and it injects 2.5 billion of assets into listed company SHC. Okay, now, so what's going on? I love drawing these balance sheets. Okay, so here's the beginning. So SHC. Assume SHC had total 2 billion of assets. Okay, so on the asset side, so this is asset. This was worth $2 billion, and then before the injection, and acquires new parcel of assets from PTY through a consideration of 4.5 billion new shares. Suppose SHC had 2.5 billion shares in issue before. Now I need to figure out what happens before we go to the after part. So before, SHC looked like this, and this is $2 billion, but on the other side is 2.5 billion shares. So you got to be careful what you're dealing with, okay? 2.5 billion shares, of which 30% is owned by TYC, okay? So this is 30% owned by TYC. So the other 70% by somebody else. Which is the other 70% constitute SHC's public float and are held by parties independent, okay? So TYC basically is holding 0.75 billion shares, okay? And after the asset injection, they actually inject $2.5 billion of assets. I'm not really drawing this to scale, okay? It's a bit bigger. So a lot of assets coming in, and the way SHC is paying for it is by issuing new shares, okay? Quite a lot of it, actually. Did they tell you how many? 4.5 billion, okay? So 4.5 billion new shares. If I were you, and you know, I came to this course new a couple of years ago, so my thought process is very much like a student, or maybe a slightly more experienced one. But nevertheless, if I were you, I think if I'm in the exam, I would draw diagrams like that. It just makes everything clear, okay? And you make life easier for yourself, okay? Now, I don't even know what questions are coming up, but I have an idea of what they're going to ask. Acquirer, acquiree, okay, that's simple. TYC's voting interest in SHC after completion of the asset injection. Simple. I know this is, what, 7? Yeah, shares, that is 7 billion shares, of which they have, in fact, the answer is practically looking at you, isn't it? 0.75 divided by 7, is that right? Yeah, so around 10.7%. The voting right of the new party, again, so it's just this one divided by 7, which is around 65%. What is the public float? The public float, ladies and gentlemen, is just this part, thicker color. Yeah, this part, which is how much? This was 2.5 billion, but 0.75 belongs to TYC, so this must be 1.75, yeah, billion shares. With a question like that, I think you got to be clear. Don't mix up the shares and the dollars. So on the left hand side they talk about dollars, but on the right hand side you're talking about shares. Okay. According to the SFC's the codes on takeover and mergers, PTY would need to receive a whitewash waiver in order to escape the general offer requirement. How many of the total number of shares outstanding could potentially be mobilized? How many people can you ask? In other words, well, you can ask all the green ones, okay? You can ask all the green ones to whether they will consider giving you a waiver, okay? I'll talk about this in a moment. I'll talk about it a bit more, okay? The rest of this, I think, are quite simple, okay? total asset ratio, well, the ratio is right here, okay, 2.5 divided by 2, and the ECR ratio on the just the equity, on the equity side, 4.5 divided by 2.5, okay. I think these remaining questions I can discuss with you within the context of, these are very simple questions on warrants. Within the context of the notes that I have prepared today, now I actually spent quite a bit of time thinking about this because in my experience, students often get confused on this topic. So I try to lay it out in a way that hopefully will be helpful for you. Okay? I'm not adding to your work. I'm trying to simplify it and reduce a vast amount of information into some sort of order, as you will see in a moment. Okay. Now, takeover and privatization are different things. So a takeover is when an investor slowly gains overall control of a company such that they can make a lot of the key decisions because they have majority ownership. That is takeover, and there are different types of shareholders, as you know. You should actually get to know all of these. I will show you in a minute, okay? And I hope that the way I am presenting it to you will make it clear. Now, privatization, like I said, I wasn't sure if I should go through the assignment first or this first. But anyway, so privatization is actually when the company is no longer a listed entity, so it's not tradable in the stock market. You cannot buy the shares or sell the shares. It is a private company. You and I, technically, okay, anybody can start a private company, and I have done in the past, for example, okay, and no one can touch it, and no one can buy my shares. I'm not selling, and I'm not under any obligation to disclose any information to anyone, except my accountants for tax reporting purposes. But other than that, okay, I'm under no obligation. So that is a private company. If you want to think about this in a simple way, the way I think about it is, I mean, why do people go to the stock market? Why bother taking all the trouble to do an IPO? There is a reason. It's not just so that, oh, you look so cool, you have an IPO, okay, you are a listed company. No, IPO is just the first step. It's the initial public offering. So you get a big chunk of capital, equity capital. So now the whole world knows who you are. It doesn't end there, okay? So I think I use the analogy, it's like a tap. And you turn it, I mean, it's not that simple, but you can turn it on and then the water comes out. Now, what do you mean turn on the tap? Things like a seasoned offer, things like a rights issue, for instance, okay, and stuff like that, or things like a block trade. You turn on the tap. Now, private company, you can still, yeah, you can go out there and you can ask big investors to fund you or invest in you, but it's a bit like a well. Don't expect you can turn it on and off just like people do if they are listed in the stock market. You see what I'm saying? Yeah. Don't take that seriously, but I try to make the analogy come alive. Okay. And takeover can sometimes lead to privatization, as you know. Okay, and the intention of a takeover is to get control of a company, but it doesn't mean you need to take a company private. Sometimes it ends up happening. Okay, now this will all become clear to you in a moment, because I'm going to show you this, what I call migration zones. Okay, I haven't seen any textbook representing it like this, so I decided to make my own. Okay, if there are any mistakes, you tell me. Okay, but so what I call normal shareholder, you and me, is just 5%. Okay, so a substantial shareholder is anyone from 5 to 20. Okay, 30. Sorry, a controlling shareholder. Actually, you don't have control yet. Or you don't have absolute control between 30 and 50. But once you reach 30 and beyond, that's when things start to get interesting. Between 50 to 75, you are a majority shareholder. Between 75 and 90, you may have to think of delisting. What's the reason for that? Because exactly, your float may not be enough. Okay, and then the last step, of course, is you take it private. Now, so if you go from area A to B, the consequence. What is the consequence? Not much. Nothing happens. And if you go from anywhere from B to anywhere in B, I'm sorry? Is it? Uh, they changed. It's 5%. Shall we take an average? Honestly, sometimes I'm not good on the minor details, but this I got the info, I think, from Hong Kong X. The problem that we have in Hong Kong, as you might know, is that the financial markets. But anyway, thank you for that feedback. But you are okay with the chart that I've done here, I hope. Yeah. So whether it's 5% or 10%, I think the most interesting thing is when you go from B into C, and you trigger off what is called a mandatory conditional general offer. Now I'll say a few more things on that in just a moment. And then when you are in C, so the funny thing is, if you are in C, you must have got from B to C at some point in time. Okay, and then if you are in C, so let's say you are 32%, and then every year you are only allowed to buy 2% maximum, without triggering off a conditional offer. Okay, so that's this one here. If you go from C to D, you also will trigger a mandatory unconditional offer. Okay, so I think that means if you go from even 49.9 to 50.1, now that's not 2%, okay, but you have now reached absolute majority. I'll explain in a moment why these things are in place, okay. So we continue. If you go from C, directly to E. Okay, so we talked about from C to D, so now from C to E, you also will trigger this mandatory unconditional general offer. And in fact, you may have to end up selling stocks in the market. Okay. If you are already a majority shareholder, so if you are already here somewhere, now things actually take a different turn. Once you reach more than 50% or more, if you are already here to start with, I think the problem with going any further is that you may have to, you don't have enough float in your company, basically. Okay, so that becomes a problem. And if you go all the way, then you are going down the road of either delisting or going private. And then there is the alternate scheme or scheme of arrangement. And we discussed that earlier on in the assignment. So it's good that we went through the assignment. I just want to say a few things about general conditional offer, conditional general offer. Hopefully I help you understand more instead of just memorizing the rules and not really having a full appreciation. Now, an offer, actually, in law, the term offer is something that has a legal significance in a commercial transaction. And offer and acceptance actually they go together. There's somebody who makes an offer. I make an offer to you, and you accept. Okay, that's how it works. Now, when you make an offer to somebody, okay, so let's say for example, I currently have 29% ownership in a company, and suddenly I buy another 3%, and it takes me to 32. And I think there was an assignment question like that. Now, the rule is, if I do that, there are 68% of shares outstanding belonging to other people. Okay, I actually have to offer. Let's say I bought at $10 previously. I have to offer to the other 68% of people to buy up all their shares if they want to sell to me. Now, that's what offer means, okay? It's like, if after you go for a successful job interview, okay, and a company makes you a job offer, what actually does that mean? The offer means they give you something, and they give you a period of time to consider that something, and they can't cancel it, okay? Or they can cancel it, but if before they actually get a chance to cancel, if you say, okay, I accept, okay, then by law, they can't say, oh, I'm sorry, I changed my mind. They can't do that, okay? That's so the offer actually has, has very significant legal meaning. Now, so I'm saying here, so this is the spirit of contract law, and the reason why the general offer is a very powerful deterrent on cavalier or irrational takeover actions. Because the reason is, a general offer is something that you are going to give to the remaining shareholders, all of them, okay? Once you trigger the takeover code, and if they all want to sell to you, you have to buy from them at the specific price. And so you better make sure you actually have that money available, okay? Because if you really get all the other shareholders selling to you and you don't have money to pay for it, basically you are in default or you are in breach of contract and they can sue you and you could go bankrupt, okay? Are you with me there? Now, why do we do that? The reason we have this, and it's not just Hong Kong, is that, you know, when you seriously want to gain control of a company and take it over, okay? I mean, that is a serious matter. And there are people who have a lot of money to throw around, but if they just buy, 3% of this company and 10% of that company, and then 1 week later, they just flip it like that, right? With actually no intention whatever of taking over the company, the market will just be in complete chaos. We'll never get anything done because it will just keep going up and down like a yo-yo, okay? So one day is Tycoon X doing this and making his 500 million profit. The week after will be Tycoon Y. The week after will be Tycoon Z. Everyone, because when someone intends to take over a company, normally the share price is very, very sensitive to that kind of action. So even if it is a rumor, okay, it better be a pretty substantial rumor, which is to say, you better make sure you have the money to follow through. Are you with me? Yeah, that is why we do all this stuff with the general conditional offer. Okay, I think that is worth pointing out. Well, you guys were aware of that. You had that understanding. Okay. Now, by the way, a voluntary offer. Okay, I make a point here. Any person, I don't know if Paul said this to you, and like I said, I'm not adding to your work. I'm trying to deepen your understanding. Any person actually can make a voluntary offer, provided that offer will not trigger a mandatory offer or the creeper rule. For example, let's say I have a lot of money, okay, and I go to a company and I make a voluntary offer, and suddenly I say to everyone, okay, I say to all the shareholders, okay, anyone wants to sell to me at, let's say the share price is trading at 8, all right? The share price is trading at 8, and I say to you, okay, anyone who wants to sell to me at 10, go right ahead. I'll buy it from you, okay? Now, the problem is if you do that, you could get a whole load of people selling to you, and you go all the way to 45 or 50 or whatever, in which case you are going to trigger off the mandatory offer, the mandatory conditional offer. Let's say you change your wording and you go out there and you say, all right, I will buy shares from anybody at $10, but as soon as I reach 29%, I'm going to stop. If you say it like that, do you have a problem? You don't have a problem because you know that at 29% you will not trigger a mandatory offer. Okay, now this paragraph I actually got from a lawyer, so it is it's pretty much accurate. I want to bring that to your attention because actually in the assignment, somebody was asking me, which question? It was the last true-false question. Okay, a party wishing to conduct a question 35. A party wishing to conduct a voluntary general offer must hold at least 50% of the target company shares before it is able to make such an offer. False. And people are asking, why is that? I've just given you the reason, which is the bullet point at the bottom, okay? You can make a voluntary offer at any time, okay? Just don't get in trouble stepping onto these landmines like the 30% point or or triggering off the creeper rule and stuff like that. But anyone, anytime can make a voluntary offer. All right. I want to make this point and bring your attention to question 35. Now, just to carry on, what is the conditional general offer? That is when you say to everyone, I will buy your shares at a certain price, whoever wants to sell to me. But if in the end, all the shares that you have accumulated together with what you currently have, if it's less than 50%, you can say, all right, no trade, okay? That's why it's conditional. So you may or may not have to buy it if it's less than 50%. You're all okay with that? Everyone is okay with that? Yeah? So for example, if I'm now, I'm 31% and I buy 3%, which takes me to 34, I'm going to trigger the creeper rule, and then a lot of people sell to me, but in the end, only an additional 15% sell to me, so I'm now 49. I actually can say to these people, oh, I'm so sorry, because I haven't got more than 50, so we don't have to trade, and then you just remain at 34, okay? What if I go from 31 to 34 and then another 17% sells to me, which takes me to 51? What will happen then? Do I have to buy from them or not? You do, right? So it now becomes unconditional, okay? So I think you guys are okay with that. So you making the offer, is compulsory, even if in the end it may not actually get done. Okay, but you have to make that offer, and you have to have the cash. All right. So why is it that we have the takeover code? Is to, I guess, stop people from trying to manipulate the market. And try to push it around, okay? Now, and to make sure that you really have to have deep pockets. Deep pockets is another word for saying that you have a lot of money, okay? So you have deep pockets with a lot of cash. Don't go into it lightly, okay? Think about it before you really step in. Note that it is hard to go from substantial, to go from less than 30% to more than 30%. But once you pass that point, if you accumulate 2% a year, well, I mean, it will take you 10 years to have absolute control. But once you have more than 50%, I think the game changes, as you know, okay? This is why in the Nam-Thai trade, they were able to make that offer because they were already a majority shareholder, okay? So they don't have any obligation to make those mandatory offer anymore. Something to think about, okay? Now, I want to talk a bit about reverse takeovers, which is a very interesting topic. And some of you were asking me, and I think you make sure you can answer these questions that I'm flashing up now. Okay, what is the reverse takeover? Is there actually a specific definition? By that, I don't mean a textbook definition, a legal or regulatory definition of reverse takeover. More on that in a minute. Okay, what actually motivates it, or often called a backdoor listing? Okay. what is a VSA, or very substantial acquisition? I think you all know that. What is change of control? It's just more than 30% ownership. And why do regulators want to prevent improper backdoor listings or reverse takeovers by raising disclosure standards? I think if you can answer all these, you're in pretty good shape, okay? And so to answer the first one, okay, the first couple, I actually provide answers here. An RTO is broadly defined as injecting assets into a listed entity, okay, and then getting it to issue shares, and in order to achieve a listing of the acquired assets, which previously were unlisted, okay, and then is a means to circumvent the listing rules for listing applicant. Now, this is what's called, this is a principle-based test, which means there is a degree of judgment that the regulator would apply. Is there a specific definition in the legal sense or in the regulatory sense? The answer is that if you go to a regulator and ask them what is the reverse takeover, is he going to say, or she, is he going to say 1, 2, 3, 4, 5, boom, 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 boom? That's the reverse takeover. Do you have a list of criteria like that? The answer is no. Okay, it's like a pink elephant. Okay, you know it when you see one. So there are two tests in the called bright line tests in the listing rules, which are which involve the change in control of a listed issuer, and the other is what's called a very substantial acquisition, or VSA, from the incoming controlling shareholder. Okay. So if a transaction falls within these tests, it is likely to be considered as a reverse takeover. And in Hong Kong, the regulators, their approach is, if they think you are trying to do that, the requirements that they will ask for your disclosure would be similar to what they ask for in an IPO, precisely because they don't want people to do that. Okay, IPO has a lot of disclosure requirements, and some people try to go around. There's in Chinese there is a saying. How do you say that? 解后，对, something like that. Yeah. And it's something that the regulators do not encourage. Okay, so I have here summarized a number of tests and how they are quantified. Okay, now I just want to share with you what is a classic simple takeover. Okay, so let's say you have company A tries to take over company B, okay? And so this is company B. And so what company A can do is either by paying cash, so paying away some of the cash and then buying a big part of the equity, okay? So the cash will go to the shareholders of this company, and then the equity will now belong to the asset side of company A. Now that's a very classical, simple, actual takeover because you have control over the equity base, you own the company. Okay, now that's a classic takeover. a classic asset injection, okay, a real one, okay, a real one would be, so company A, now I'm talking about when you are not trying to do a backdoor listing, okay? So company A looks at company B and it doesn't actually want to buy the entire company, company B. Give you an example. So let's say HSBC, okay? Now, under HSBC, there is the bank, all right? There is insurance, and there is asset management, and there is private banking. There's a whole load of stuff, and these are all separate businesses, okay, that you can spin off. And let's say they want to sell only a part of it, okay? And HSBC is over here, okay? So what you do, so they want to sell off this part. This is the asset management, okay? So company A actually wants to buy this asset management. Now, there are two ways they can do that. Either if they have some cash, okay, so they pay away this cash. So previously this was cash, but now the cash is gone, and instead they have the asset management here. Okay, now this really is a so the asset now is injected into this company's balance sheet. That's one way. Now the other way, of course, is you don't have cash, so you actually issue new shares in order to buy this new asset. You're not buying the whole HSBC, you're just buying the part that you like. Are you with me? Now, here's the problem. So this is a classic and well-behaved, a real transaction when company A really wants to buy a part of somebody else's business, either by cash, then there is no doubt that it is a real asset injection, or even by issuing new shares. The problem is this is now subject to abuse in a sort of backdoor listing, which I think is a better name, okay? Reverse takeover or backdoor listing. That is when company A, it has the advantage of being a listed company, so it is already, at least legally or technically, trading or capable of trading in the stock market, and it has a public float. But income company B, and company B also has a substantial balance sheet, and company B ends up selling so much assets to company A. Okay, I wish I could use color. Here, I don't think I can. So they sell all these assets to company A. In fact, quite often, even more assets than what company A has. Okay, so a huge chunk. And then company A issues new shares. So this is old equity. Okay, and you could see that in that assignment question. This is new equity. Now, where does this go? All of that would end up here, okay? So the assets have gone from here. The assets have gone into here. And then a new equity basically is owned by this company. So suddenly, it looks like actually A is not taking over B. It looks like B is taking over A. You know what I'm saying? Don't you think this is so interesting? Yeah. people in finance are so smart. Huh? Um, and here's the problem, okay? And regulators recognize and they say, okay, I see, I know what you're trying to do, okay? And this is what they try to prevent by, having a couple of tests, including, whether the incoming, new equity, does it actually make you, would it actually give you a control over this new entity? And then whether the incoming assets are even bigger than the pre-existing asset base. Okay, that's known as the asset ratio test. You guys are okay with that, right? I had that earlier. Yeah. Correct. Yeah. Yeah. You mean here? This is actually now an asset. Whoops. An asset basically is anything, hopefully, anything that can go up in value, number one, and anything that gives you an income. Okay. So an asset can be a factory, an asset can be gold, an asset can be stocks. Okay. In this case, the asset for B is the equity issued by A, the new equity. That is the asset. Is that your question? Okay. Now, I'm glad you asked that because otherwise I don't know whether I'm going too fast or too slow. What company B should do, all right, if they really want, if they have a business, what people normally do is they have a business of some kind, whatever it might be, and the act of IPO means you want to take your business to the public. You want them to buy your shares, and your shares are here. Okay, this is your equity. Okay, and you want to list this one, which is people buying your shares here. All right, in order to invest in your assets, the old assets, okay, which are now here, okay. Now that is the spirit of IPO. That is the spirit of the stock market, and in doing that, you want people to buy this and take part in this, right? There are a lot of disclosure requirements, and regulators ask a lot of questions about your business, your profit track record, and what business you are doing, and this and that. The problem now is by doing that, you have kind of achieved your objective, which is you now have assets on the left-hand side of the balance sheet, okay, and you have investors who are able to trade on your shares because this company is listed. So it is a platform that will provide tradable equity. Okay. The damage is you have now done what you wanted to do, but without going through all the disclosure requirements. Because that all the hard work was done by this one. Yeah. So people pay for that kind of stuff. Okay. That is the damage. The damage is you've kind of bypassed what regulators would like you to do in terms of disclosure. Okay. Is that okay? Yeah. So I hope it's now clear for everyone. Okay. I know the rules are important, of course they are, but for me, I am equally fascinated by the the commercial motivation or the psychology behind it. Okay. Do you guys have to go? You don't? Okay. You okay if we continue till around 11? No, I'll just take a few more minutes. Okay, I want to answer some questions and then we can. Okay, so that's what I want to talk about regarding reverse takeovers, which is a very is an interesting topic. I want to just answer a few questions. This is one about IPO shares and listing shares. Dear Sam, just read it. Okay. So company A has 100 million shares. Actually, I gotta go myself soon. Company A has maybe another 5-10 minutes. 100 million shares, all held by shareholder A, and now it's going to do an IPO in Hong Kong with primary offer of 40 million shares. IPO shares in Hong Kong is 40 million, correct? But the listing shares will be 140 million or still the 40 million? It's 140, okay? The public float is 40. I guess in the end, look, you are listing a company. You are listing a company, so you are listing the entire equity base, if you really want to think of it that way. Okay, whether it is in public float or not, it's not so important. Okay, the company is listed, so all the shares are listed. Okay. Okay, this one regarding stock repurchase, I have some confusion. If a U.S. company buys back its shares through on-market purchase with the option to turn them into corporate treasury stock, does it need to disclose to the market how it treats the repurchased shares? Well, I think we know how it's supposed to be treated, which is you don't count it, okay? Why, when corporate treasury stocks were to feature, there will be no effect on issue share capital account? Are these shares out of the outstanding shares? According to the calculation of IC balance number of our share, why I see no account change in the illustration in page 3, file company buyback from professor, okay? There is change in previous illustration when the repurchase shares are cancelled right away. Furthermore, for processing company, how do we calculate the IC balance, and does it have two accounts? One for IC is issue share capital. Yeah, of course there are two accounts. They are not fungible. A and H shares. Would you mind providing me relative accounting change knowledge? Wow, that's a challenge for me. I would start by looking at it like this first. Okay, I prefer the Hong Kong way. You know, in Hong Kong, we don't have such thing called treasury stock, which means when a company has equity, and let's say they have a lot of cash, all right, and then if they buy back the shares, that's it. The money is gone, the equity is gone, and it becomes like this, right? So it's quite simple. Once you buy it back, tear it up, put it in the trash bin, that's it. Now, in the United States and some other jurisdictions, so what you do is, so before it looks like this, and then you still pay the cash. You pay the cash, you buy the stocks, okay? But the problem is so the balance sheet has to shrink. It does, okay? But when there are so-called treasury stocks, what you do is, okay, if this is X, let's call this X. You actually move the whole thing. Imagine this box here, okay? You move the whole thing up to, let's say, here, okay? So this is still X. Now, you're wondering, what is going on, okay? Well, if you read Paul's notes carefully, and this student actually referred to page 3 of the file company buyback, one of the leaflet that Paul actually produced, okay? If you read that carefully, what happens is there is actually a negative account. There is another extra account with a negative balance, okay? So when you add the two together, okay, the end result will be an equity base that actually looks like this, which is the same as when you reduce it. So what I mean is, and I use a different color, a different thickness. This size, all right, is supposed to be the same as this size here. It's just that they don't reduce the issue share capital. Okay, so that stays the same, but there is an offsetting account hiding somewhere else. And if you read one of Paul's publications, on company buybacks, I think he did actually put something out. This one. Here. Okay. See how there is a negative account here. Okay. So this negative offsetting account is what I mean by although you don't change your issue share capital, okay, so they keep that constant, but there are things happening elsewhere. And in the end, it's really quite simple. So the way Hong Kong does it is the simple way, is the easy way, is what everyone understands. And whatever you do with the treasury stocks, okay, the end result should be the same as if they are cancelled. Okay, think of it like that. Okay, so I am Apple, and suddenly I spend the money. The money's already gone out the door. Okay, I buy the shares back. What use are these? Completely useless. Okay, now what can they be used for? I'll tell you what they can be used for. I just put it in the drawer. Okay, I forget about it. But one day, if I want to reissue shares, I may be able to just take them out and bring them back alive. But otherwise, there is not much difference me putting it here or me just putting it in the trash bin out there. Okay, you should think of it like that. Are you with me? Yeah. And that is what this negative entry here is doing. Okay. Now, just very quickly, because I'm sure you want to go and I do as well. Dear Sam, can you explain why Xiaomi lost so much money before its IPO? I always wanted to talk about this. And if you look carefully at Xiaomi's shareholders report, just prior to their IPO, you see that at the start of January 2015, it looks like this. And then at the end of the year and at the start of the next year, now change in fair value refers to, this is actually related to the convertible redeemable preference shares changing in fair value. Now, during the year, just prior to the IPO, so at the turn of, end of last year, there is suddenly a 54, by the way, this is 1,000 renminbi, so it's $54 billion, okay? One thing that I want to, draw to your attention is that, when you see stocks trading in the stock market, and it's all very exciting, and you see stock prices blinking and moving up and down, but have you ever thought what is actually going on when the stock prices are changing? They are changing not because, okay, so you got assets and debt, or liabilities, if you want, okay, liabilities and equity. Now, the equity part is the one that gets the most attention, okay, and it's the part that is hopping up and down, but it's hopping up and down simply because the asset values are hopping up and down. You are making money, you're losing money, you bought a new business, you have a new factory, a new piece of land, a new shopping mall, all of these things, okay, your asset values are changing. And in addition, your liability values are changing. So people often, they don't think about that, okay? Now, think of it this way. Equity, asset, or I write it the other way around, asset and equity, okay? Now, when your asset values go up, when you are making money, what happens to your equity? This goes up, of course, right? You're making money, you have retained earnings or, huge profit, your equity base starts to grow. What people don't realize sometimes is when your liabilities go up, and they can, what happens to your equity? It goes down, okay? How does that work? So this is your original balance sheet. So you have assets. Imagine you bought an apartment which is worth $10 million and you borrow, let's say you borrow $7 million. Okay, so this is your liabilities. Now that's a very simple balance sheet, and 3 million. Now you'll be lucky if your asset value doesn't change, okay? But let's just say you you missed a couple of payments, okay? And now the bank actually is giving you a penalty. And they say, all right, we're gonna double your interest rates, okay? What does that do to the liability? It's gonna increase it. So the 7 million liability now becomes an 8 million liability. Guess what? It's just wiped out 1 million of your equity. The logic is if you were to sell your apartment right away and you want to pay everything off, you only have $2 million left, okay? So when your liability goes up, it actually can hurt your equity. Now, in this case, actually the liability went up because the price of a convertible bond, convertible preference share that they issued, the value of that has gone up. So I guess that's good news in a way. Okay, it just means the company is doing well. And one further interesting and critical point to mention is that whether they end up actually really losing money or not would depend on how the conversion is settled. Okay, if it is cash settled, they lose a lot of money. Okay, but if they actually issue shares, which means it's physical delivery, then actually they don't. They just print. They just print new share certificates and give these out. So finance sometimes it is fascinating that way. Okay, same transaction but different delivery mechanism can mean a completely different world. Okay, all right. So it's kind of late for everyone. So today we had not much housekeeping. We did talk about assignment number 3 and went through it selectively. We went through is that how you spell privatization? Privatization? No, it's VA, isn't it? Jesus. All right. Privatization and takeover. We had a look also at reverse takeover, which is a related topic, but with a slightly different mindset. Okay, I answered some of your questions, and I wish you all the best on Saturday. Thank you very much for coming. I hope it's been helpful. Feel free to go home and review these diagrams. Okay, I try to make this final tutorial useful for you, and I trust it will be. Okay, especially these things. All right. Have a very nice evening. Okay, thanks for coming, and I gotta go home too. Okay. Thanks, guys. This will be available on video, so for your friends who can't come tonight, you let them know that I will produce this soon and possibly put it online tomorrow. Okay? Thanks, everyone. Good night.